about to go on a journey, a really amazing journey. But before you do that, I want to personally thank you for buying the tapes and for sitting with me the next 6 or 7 hours of learning about the market. What I want you to mostly know is how good I feel about these tapes, because this is being taped now over a year from when the tape was made that you're about to see, the learning tape. And in that ensuing 12 or 13 months, a couple of thousand people have gone on the journey that you're about to go on. Those people have written me, they've called me, they've faxed me, and a lot of them have made a great deal of money, $10, $20, $30,000 from what they learned on those tapes. Now, the people that did that got the most value out of the tapes, tell me that they watched the tape a couple of times, they read the book a couple of times, and when they had questions, they faxed me or they called me. And at the end of the tape, you'll have my fax number and my phone number. But most importantly, the people that have prospered the most from these tapes, I find, are the people that didn't get into the minutia of just charting and the little things, but the big parts about the market. When I talk about commercials, listen up. That's terribly important. When I talk about contrary opinion of the public and open interest and spreads, that's the stuff that moves the market and makes the markets forecastable. And if you really pay attention to that, you're going to catch the big things, and the little things, I think they'll take care of themselves. So continue the journey, watch your tapes, and I hope that on this journey, you'll encounter the same type of success that Larry Williams had.
I started with Larry about 1.5 years ago, and he's given me a lot of information that's helped my trades. Previously, I was not profitable, and he's helped guide me in directions that have increased my profitability and helped my trading.
My experience has been much better since I've met him.
You'll walk away with stuff that's tradable, but you'll also learn how to find your own tradable stuff by looking at these patterns.
He's the ultimate system developer. He's creative. He's an exceptional trader. He's well-disciplined, but he's multifaceted.
He talks very simply. He doesn't act like he's a know-it-all or some type of expert. He simply has found certain things that seem to work all the time. I think he's a pretty good guy.
There aren't very many people that can accomplish what Larry's accomplished in his time within the markets. And it just feels so good to be able to learn from somebody like him.
The more exposure I get from Larry Williams, I think the better off I am, you know.
Hi, I'm Larry Williams. I'd like to welcome you to my video series on how to trade commodities. I'm going to try to teach you from the very basics, the very beginnings of what the commodity markets are, how they work, the difference between stocks and commodities, so you have a groundwork and an understanding of the marketplace. I'm going on the assumption for this first hour of videotape at least that you probably don't know much about commodities, and in some instances maybe nothing at all. I'm going to try to truncate your knowledge and give you a compact version of what you need to know so you can get trading. I'm going to explain who the players are in this market, what the playing field is, how we go about predicting the markets, and the basic terms, because without the terms of this business, without the trade knowledge of how to place an order, how to deal with a broker, obviously you're not going to be able to trade. So this first hour is going to be to bring you up to speed. Then in the next tape we're going to get into how I predict the markets, how I can tell if a market is set up to go higher or lower, and the best indicators that I have, 7 of those indicators I'll be sharing with you on the tapes, as well as timing, because it's not enough to just select a market that's going to go up or down. You also have to time your entry into it. Then you need to control your risk. And speaking of risk, I want to make it clear that there's no guarantee in this videotape for anybody's that you're going to make money trading commodities. This is a business, trading commodities, and let me tell you, it's a risky business. About 80% of the people that trade probably lose. The only sure bet that I can tell you as an investment strategy to make a lot of money, to double your money for sure, is buy a Yugo car and you can double its value if you fill up the gas tank. Short of that, there's no guarantees in the investment world that I know of. It doesn't matter if it's stocks or commodities or real estate. All this is inherent with risk. And I think that's great. I think it's fun to have risk in your life. Now, if you can appreciate that statement, then you're probably going to be a good commodity trader. But if risk scares you, turn off the tape. You know, rewind it, send it back, because risk is really an exciting thing to have. We need to learn to control that risk, and the risk is a financial risk and an emotional risk. I'm going to talk a lot about that control of the emotions and how to control the financial risk. So we're not playing with unlimited risk, but without some risk in life, there's not much rush. There's not much thrill. And commodity trading can be thrilling. We just need to cut back and establish that thrill level so it's something we can live with and continue to trade. So we'll handle that for you as well. Well, that should get us started. I'd like to first talk about the differences between stocks and commodities, because there's a big difference between stocks and commodities, a huge difference now versus when I started trading stocks. I first started following stocks in 1962. Back then, there were maybe like 800 stocks, and now there's maybe 20,000, 30,000 stocks in this country and around the world that you might be interested in buying. So your universe is gargantuan. What stock do I buy? Whereas in commodities, it's still the same old wheat and pork bellies and corn and gold and silver. Our universe of what to look at is very, very small compared to a 20 or 30,000 universe of trying to select one stock out of those 20,000 stocks. That's tough. That's real tough because the sample size is so large. Whereas in commodities, not only do we have very few to look at with the tools and techniques I'm going to show you, we can bring that down to even a smaller number of the markets that are set up now to trade, to go up or to go down. So we can really get this honed in to a narrower viewpoint for us to look at, and that alone makes, I think, commodity trading much easier. The other thing I like about trading commodities versus stocks is stocks go up because of a myth. The primary motivating factor for higher stock prices has always and will always be earnings. When a company makes more money, i.e. they have an earnings increase, the price of the stock goes up. That's the bottom line to trading stocks. But there's no true supply-demand for stocks. Nobody needs a share of IBM or a share of General Motors. What can you do with a share of General Motors? It's a piece of paper. Now, you can put it on your wall, you can frame it, you can say, I bought it at a low price and sold it at a high price, or vice versa. Most people, it's vice versa. But you can't do anything. There's no intrinsic value. You can't take that share of General Motors and walk up to the company and say, I want that tire off the car over there because I own stock in General Motors. So the only supply-demand of stocks are mutual funds buying and selling, or the public buying and selling. But think about commodities. Think about corn. Is there a real demand for corn? Does somebody really need corn? Yeah, you bet. Wheat? Sure. Cocoa? Coffee? Gold? Absolutely. You've got to have gold for so many electronic processes. So there is a true supply-demand market to commodities, and that gives us a real advantage, because with that real supply-demand, we can then follow the supply-demand in the commodity market much easier than we can in the stock market. And that gives us an insight that we simply can't get in the stock market. In the stock market, all we can really do is monitor earnings and dividends and what insiders in the company are doing, and they buying or selling their stock. That's the fundamentals of the stock market. The fundamentals of the commodity market are the people that need the commodity on the supply or don't want the commodity on the supply-demand ratio. So we're going to work a lot with those supply-demand ratios, and as you'll clearly see, they're very predictive and show when a market is set up to be a long or to be a short. A couple of other differences. A share of General Motors is a share of General Motors. But when you are long a contract of, say, wheat, there are contract specifications for that wheat. It must have a certain protein content. It must have a certain moisture content. It must have a certain mineral content. So that is a deliverable grade, is what we call it, a deliverable grade contract that the Board of Trade or wherever this commodity trades has a specification. It must be this quality of wheat. It can't be bad wheat. It can't be a real soft wheat. It's a red wheat or a soft wheat or hard or whatever the protein content is how we measure the various things. You hear a pork belly contract. People like to laugh a lot about pork bellies. It's always made a joke of in sitcoms and movies and everything. Pork bellies are the underside of a hog. They're slabbed off. They weigh about 18 pounds on both sides. They're put into cold storage, and they're brought out, and we make bacon out of it. And that must have a certain fat content, a certain meat content. So we have a stabilization to what a contract is. A contract of gold is 5,000 ounces or 1,000 ounces, depending on the size of the contract. These items are actually delivered to somebody, does take delivery, or they take physical possession because they're going to use it, whereas you can take physical possession of that share of IBM. You can't do much with it. But in fact, a lot of people just have their bank hold the stock for them. But a user, an end-run user, will take the wheat or the corn and take physical delivery of that commodity. Now that's an interesting word, physical delivery. You'll hear people use the word physicals in this business, and that means the actual commodity itself. The physical contract, or the physical is the commodity. What we trade are contracts. Now these contracts expire, unlike a stock where Xerox trades forever. Pork bellies or wheat or gold is a contract of a specific time period that has a quality to it, how many ounces of protein, etc., and it expires at a certain specific time period. I'd like to show you when those time periods are so you can get a sense of how that works. We'll look at our overhead projector, and first of all, let me show you the exchanges that we trade on. The vast majority of commodities that you're going to be trading will be on the Chicago Board of Trade. Most of these boards or exchanges are in Chicago. The Chicago Mercantile. The metals are traded primarily on COMEX. That's a New York market. And also in New York, we trade coffee, sugar, and cocoa. Cotton is traded on the New York Cotton Exchange. The IMM, the International Monetary Market. And then we have the smaller markets, the Kansas City Board of Trade. The Mid-Am, this is interesting. The Mid-Am is a very small market where the contracts are a much smaller margin than, say, the Board of Trade. A margin in the Board of Trade might be, say, $5,000, and on the Mid-Am it might be $500. So if you don't have a lot of money to trade with, you'll probably start trading in the Mid-Am markets. Then you've got the Minneapolis Grain Exchange and the the New York Futures Exchange. And finally, you've got the Winnipeg exchanges. These are the different exchanges where these commodities are traded, but primarily they're traded in, the big contracts are traded in Chicago on the Board of Trade, and the Merc, where the meats are traded on the Mercantile Exchange. Now, as I mentioned earlier, these contracts actually expire. They expire by months. Not every commodity expires every month. Typically, say in the case of Treasury bonds, the expiration is March, June, September, and December. We have a code. I'd like to show you the code. This is the first inside code you're going to learn for the business. We abbreviate the month with a letter. So January, the abbreviation is F. And if I have, say, British pound, and the symbol here for the British pound is BP, if I had BPF, that would mean British pound January month. So if people will say they're in they may say they're in the D or the Z S&Ps, the month for the symbol for December is Z. So you would know if they say they're in the Z's, they're in the December of whatever that commodity might be. It might be Swiss franc as a December contract. In fact, we can then look and you'll be able to see the delivery months. In the case of the British pound, H is a delivery month, and we see that H is March. M is a delivery month. M stands for June. U is a delivery month. U is for September. And finally, Z is for December. So you can see the months that these contracts expire. There's a real advantage because when these contracts expire, because they can be in real tight demand, people want them a great deal, those markets can be driven by the commercial desires to outperform all the other contracts. So it's very important that we look at the relationship between the nearby contract, the one that's expiring now, and those out in the distance. And we'll get into that, and I'll show you how to do that. But I want you to see that we have contracts, they expire, and we can tell at what months that these contracts expire. When they expire, we call it going off the board. It's off the board. It doesn't trade any longer. Now, there's another term. Currently, this is being taped in December of 1996. I'm sorry, October 1996. If we were trading, say, a year away, next December, we would call that the red month. I don't know where the phrase came from, but if you're trading a year out, people will say, well, that's the red month because it's a year away. We're not trading the nearby December. If you're way out that far in the future, we would be in the red, or the D97 it would be, as opposed to being in the D96 if that's the month that you were trading. We also have minimum price fluctuation that these markets are worth. In the case of, let's go one that's easy to understand, soybeans, the minimum price fluctuation is 1/4 cent. And 1/4 cent is worth $50. And the margin requirement at this time is $1,500 for soybeans. Now this will change. The brokerage firms, the great thing about commodities is you don't have to put up all the money. You can trade a contract of, let's find Treasury bonds here. Treasury bonds, you can trade right now for $2,600. You're trading actually about $100,000 worth of bonds, and you only have to put up $2,600. Oh, that's a great deal. In any other investment that I know of, if you're going to buy a house that's $100,000, you've got to probably put up $20,000. Well, in Southern California, maybe you can put up $2,600 because the real estate market has been a little depressed. And then you have to pay interest on, if you put up $10,000 on a house here, and you've got $90,000 you have to pay interest on at 10%. So there's $9,000 a year in interest. That's a lot of money. The house has got to go up in value by that for you to just stay even. In the case of these commodities, there's no interest. You put up a margin deposit. It's not, there's no loan involved. You put up just a margin, and there's no financing like in stocks. If you want to buy stocks on margin, you put up 40, 50, 60% of the value. The brokerage firm lends you the rest of the money. In this case, we're buying a contract, a futures contract, and a futures contract is just that. There's no interest involved. So we really have the best of both worlds. We don't have to put up much, and there's no interest on the difference between what we put up and the face value of the contract. And that's one reason why it's possible to achieve such big results, upside or downside, because on a $100,000 bond contract, let's say the bonds move up 10%, so that's a $10,000 gain on your $2,600. So you've just about tripled your money on a 10% move. By the same token, if it comes down 10%, you're going to lose at some point before you get out. Hopefully you get out before it comes down that much. But that's why we can get such extrapolated gains. A 10% gain in the underlying futures contract can maybe equal 3 or 4 times return on your actual investment that you put up for your contract. So it offers a tremendous amount of leverage on your money, and that's it's a two-sided sword. It's the advantage of commodities, but of course it's a disadvantage if you're on the wrong side of the markets. So you need to learn how to control the wrong side of the markets by using protective stops to protect yourself so you don't lose all your money on any given one trade. Let's talk about those terms. I've used some terms. I brought some terms in here I'd like to talk with you about. The first one I use is stops. Let me explain what a stop is to you. A stop is your ability to protect yourself against a continual loss. If you've got a market that's moving up, let's say something like this, and you're long this market, maybe you were fortunate enough to buy it there, but now you're starting to get a little leery and say, gee, I don't want to lose. I don't want this market to come down. You can say, I don't want to lose more than this amount of money, and you'll place an order with your broker called a stop, which means, in this case, since we're long, we would sell on a stop at, say, 65 cents, whatever the price is here. You just give that order to your broker. I'll sell one contract on a stop at 65 cents. Now, if for some reason that market comes down and immediately does this, you will be stopped out somewhere in the 65-cent area. So you've limited your potential loss by giving your broker an order that says, I will exit on a stop. If it goes to this price, get me out. So you can protect yourself against risk. Maybe this particular trader was willing to take this much risk. Maybe you bought it at 60 cents and they would take a 5-cent risk. Another trader may say, well, I'll take a 10-cent risk. So his stop would be here. So you can vary your risk by where your stop is. In this business of trading commodities, we're primarily on the offense. We're buying, we're selling. We don't have a lot of defense. This is our defensive mechanism. The first thing I want to talk to you about is defense. The teams that win the Super Bowls are the teams with the best defense. So they have to have a good offense. That's what brought them to the Super Bowl, right? But without a defense, they're going to get beat. The defense is terribly important. We don't have a shield in this business to protect ourselves. Our shield is money management, and our shields are stops. So the first term I want you to learn is stops, and that's going to protect us. We'll sell on a stop. Now, if you were short the market, and we'll talk about that in a moment, and the market's coming down like this, you could have a stop above the market to exit your position and get you out of the market. If the market goes up there, your broker has that order actually in the exchange on the floor, and the broker on the floor, if he sees that price, will sell and get you out of your position, so you can protect against your loss in that fashion. A couple of other terms that a lot of people aren't aware of. People always hear on the news that something is bullish or bearish. I'd like to explain those terms to you. It comes from here in California. Bullish means the market's going to rally, to go higher. Bearish means the market's going to go down. It comes from the old days. Mark Twain wrote about it when in California, instead of having freeway pileups, the sport of the day was bullfights and bear fights. And everybody would gather around the fairs in the fall, and they'd bring in a bull and a bear to fight. Obviously, they didn't have television back then, or maybe they would have had MTV instead and watched that instead of bulls and bears. The bull, when the bull fights, would raise his head up with his horns to gorge into the bear. And so that's an uplifting market. And the bear would come down like that on the bull, trying to bring those claws into the back of the bull. So a down market is a bear market. That's where the term comes from. And an up market is a bull market, the bull thrusting his horns to the upside. So if you're bullish, you think the market's going to go higher. If you're bearish, you think the market's going to go lower. And that most people talk about he's bullish, he's bearish. Now you know what the term means. Bearish means you hope it goes lower. Bullish means you hope that it's going to go higher. One of the really fascinating things to me about the market, stocks or commodities, is that you can make money when the market goes down. Unfortunately, you can't do that in real estate. It'd be great if you could. But there's no way that I know of doing that. If you think a market's going to go down, you can actually make money when it goes down. That term is called selling short. Now, I'll try to explain it to you. Bear with me on this one. What happens is the reverse. Usually you buy something, right? Anybody ever bought a piece of real estate here? Anybody? Yeah, 1, 2 people admit it. That's good. And hopefully it goes up in value, and then you sell it and make your profit. Selling short is just the reverse. You sell the thing first. Then you buy it to cover later on to replace what you sold. The easiest way maybe of understanding it is like this. I'm going to borrow his soybeans. We'll just use this for sake of argument. And he's happy. I'm going to give him something, whatever. I borrow his soybeans, and I come over here to somebody who wants to buy the soybeans. And he says, yeah, I'll buy the soybeans, Larry, from you for 60 cents a bushel. So I say, here they are. They're all yours. I've now sold the soybeans, but I owe him soybeans, don't I? Hopefully those soybeans will drop to 40 cents. And then I come over here and I buy the soybeans for 40 cents and say, here they are. You got your beans back. Now, that's the way it works in stocks. It's a little different in commodities, but it gets the point across, I hope, that I can actually take something that I don't own and sell it over here, because I will buy it back later on to cover the long position, to cover the transaction. So it's just the reverse. Instead of buying first and then selling, if you're selling short, you sell it first, and then you buy it, hopefully at a lower price. Now, that isn't always true. If the market goes up, and he was right on the bet, if you will, because beans went from 60 cents to 70 cents, I'm short, and I'm losing as they go higher, I still have to buy to cover my short position, and I will then lose from 60 cents to wherever I buy. So I can lose money or I can make money selling short. The classic argument against short selling is if you sell soybeans at 60 cents, they can only go to 0. But if I buy them at 60 cents, they could go to 120, 220, 420, 520, whatever. They can go to any up. It's unlimited on the upside. But a stock or a commodity can ultimately only go to 0. You can't make any more than that. On a long-term basis, that's really true, but most long-term commodity traders are dead. There's not much long-term in this business. Long-term is maybe a couple hours for some traders, 10, 15 minutes for others, and certainly maybe 2 or 3 months is a real long-term commodity trade. So we're not too concerned about the real long-term commodity trades, and a short seller can make a good deal of money in the market. If the market drops, you can pick up a good lick in the market. So if you're looking for the market to go down, you're going to be a short seller, and you do that by selling something you don't own. You sold it, and then you buy it, and the difference between where you sold it early and where you bought it is your profit or your loss in the trade. So that's short selling. Everybody, I think, understands the idea of buying something, hoping it goes up, sell it, and if it goes down, you also have to sell it and get out and take your lumps. Those are the two things that we'll be doing, buying or selling short. Now, there's another position, and this is the most, probably the best position. You can be long a market, you can be short a market, or there's a third position called being flat. or no position at all. Wonderful position. You know, you can't lose money when you don't have a position. It's very nervous because you always want to be in the market. You always, you know, I mean, everybody wants to be in a market making money hand over fist every day, so your nerves kind of drive you into getting into positions. It's something we have to contend with all the time. That's one of my problems. I love to trade. This is the funnest thing I've ever found in my life. So I want to be long or short, the same commodity even. And you can't do that. So there is a third position, which is to be flat. And most people don't use that position often enough. I would say that it's better to be flat or no position, to exit on your trade and just sit back and say, what's happening now, as opposed to always being in the market. Invariably, when people have watched this video series and call me up, they will say, yeah, they're long this market, they're short, they're in 4 or 5 or 6 markets. They're way over trading and way too many markets, and they want to be every market, every tick. And I just say, you know, it's hard. It's a hard business. This is not an easy business. It's tough to predict the markets. I want to focus on as fewer trades than as opposed to many trades. And it's a very valid position to have no position at all, to be flat. So you'll hear me use that term also. Being flat means we went flat, we got out of the trade. Whether it's a long or a short, we have no position. Our account is flat. It shows no position in the account. So our position will be long, short, or will be flat. We're sitting on the sidelines with no position. And those are the positions that we can have. Now, there are other positions. You can be in an option, and you can be in a spread, and that's a little advanced. For this tape series, I'm going to start with just the basics, and later on you can get into the more sophisticated. But even as long as I've been trading the market, I keep it really simple. I think if there's any strength or wisdom to what I do, that it's very simple, that I don't try to get terribly complicated in my work. And that's not to say that there isn't a place to be complicated. It's just that I'm not smart enough to be complicated. And I have enough trouble figuring out if the market's going to go up or down, let alone figuring out options, spreads, strips, straps, straddles, all these other terms that you learn about as you progress in the business. I just want to figure out if it's going to go up or down. And I'll focus on that because there's enough money to be made there. If you think the market's going to go up, you could get an option on the market. There you put up even less money. And if the market goes up in value, you're going to make a lot more money. And your loss is limited on the option, so you can only lose what you put up for the price of the option. That's the pitch that everybody gives you from the brokerage community. Well, if you buy an option for $500, you can't lose more than $500. If I buy the contract of soybeans and they drop down, I may lose $1,000 or $1,500. So I've got to control my loss in the actual owning the soybeans with my protective stop. But if I go through the stop or I don't use the stop, I could lose more than I put up. And in the options, you can only lose the $500 that you put up or $300 you put up for the option. However, there's a problem there. Let me explain that problem. Options lose value every single day. So while the price of the market may actually be rallying, the option can actually come down because you have a premium in the option. And this premium expires or dwindles away. So you can lose money holding an option while the market goes up. You predicted right. The market went up, right? But the value of the option went down. And I've seen that happen. I was in Chicago not long ago, and I had a signal to buy the S&Ps on a Friday morning and get out on the close Friday, which is an unusual signal for me. And I did it, and somebody said, oh, you should do the option, Larry. So I said, well, let's watch the option today. Had I bought the option on the opening, got out on the close, I would have lost money. As is, I made about $1,700 a contract buying the futures and getting out on the close. I would have made money had I bought a put, strangely enough, and in other words, been short, and got out on the close. So I want to keep it real simple, and I'll stay with just the futures contracts, with the exception if I see a major move coming, then you could say, you know, I'm going to buy a couple options in here, or if you don't have much money, you're starting with maybe $1,000 in the market, and you can't afford the margin requirements of $3,000, $4,000, $5,000, $6,000, $10,000, then you could buy an option, but you don't do that every day. You do that when you think you've got a market that's really set to go up. Everything is there, as I'm going to teach you in the next series of tapes. It's all there. All the big guns are there. Then you can take an option. But you want some time because we can't predict exactly when the market's going to bottom. You want some time for that option to work itself into a profitable position. You want to buy those options as cheaply as you can. You don't want to pay a lot for them because you need some time now for this trade to start to rally or for the market to start to go down. And usually when my stuff is set up is when the options are at the best value. So I think the best option is to trade an option for a longer-term move. When we get a market, we say, we know the chances of this market going up are high, 80%. Then you can take an option, and your risk is limited to what you're going to put up on. It's probably going to expire worthless. Or you're going to make a lot of money. The interesting thing about options is I think about 90% of them expire worthless. In other words, all the money that people put up expires. So they're losing all their money most of the time. So the fact that the brokerage community will say, or a lot of officers will say, well, you can only lose what you put up if you trade options. That's true. But if 90% of them expire worthless, what does that mean? It means you're going to lose 90% of your money. So it's just a slower way of losing your money. You know? I mean, if you're a real masochist, you'll probably want to trade commodities if you're losing because they're going to happen quicker. If you want to endure the pain a little bit longer, well, then you're probably going to want to trade options. But it isn't the mechanism, the option or the futures contract that makes you money. It's being right on the market that makes you money. Predicting, being able to understand this market should go up, this market should go down. That's what makes the money. It's not the vehicle that makes money. It isn't the option or the futures contract. It's, are you right on the market? And that takes thinking, and it takes an understanding of the market, and that's what, of course, we're going to have on the second tape, so you get to understand that. But I want you to know about these vehicles of the different things that are there for you to trade with. Well, let's see what other terms we have to go over. Let's talk about the market itself, what a market looks like. I look at charts, and this is a typical chart. This happens to be the February 92 pork belly contract. I'd like to just show you a few things, and then we'll get even a closer-up view of this, and you can see what the markets look like. I keep these charts every single day, have for in my own chart book for, 30-some years now, day after day, of posting these little lines here. And I'm going to show you what's on these lines so you can see what you need to keep. Basically, every day in the market, we're given a set of figures, and the set of figures that we're given, we have an opening price. That's the very first price where the market trades. We have a high for the day. We have a low for the day. And then we have where the market closes for the day. Usually this bar will look something like this. This is the high for the day. That's the low. That's the close. And this is the opening. And on charts, when you see a chart, you'll see it looking like this. Now, if we zoom in on this chart, or maybe I've got a chart that I blew up. If we can zoom in on this chart, we'll be able to see a real tight view of this chart. We can see the high-low closes, maybe right in this area right here. You can see where we have a high for the day, a low. There's where we opened on the left side of that bar, and finally we have the close up there on the right side of the bar. That's the data that we have every single day from the marketplace. That's the data that's used most often by technicians. And I'll talk about technicians a little bit. This is what the actual physical price of that commodity did on any given day. There's some other data that we also get. We get volume. Volume is the number of contracts. In other words, how many contracts traded here on this given day. You may have a day that trades 1,000 contracts, and the next day it trades 50,000 contracts. Volume is an important number for us to look at, because volume is like water in a swimming pool. If there's only 500 contracts trading, that's not much water in the swimming pool, and you can't get in and out easily. If volume is 100,000 contracts, well, there's a lot of players in the pool, and there's a lot of people you can buy and sell from or with. But if there's only 500 of them and you want to get out, they might say, heck with you. Or they might want to get out too. So the market will have wild gyration, big moves, drops to the downside, rallies to the upside. But we call this liquidity. The more volume there is, the more liquid a market is. And you want to trade in the liquid markets. If there's one thing that's terribly important, it's trading in liquid markets. An illiquid market, one that trades a couple hundred contracts a day, 500 contracts a day, you can't, especially if you have any size to your positions, you can't get in and out easily. You may think these tapes cost you a lot of money for a couple $100, whatever you paid for them. Let me give you a lesson about liquidity. I was long propane in 1973 or 74, and at locked limit, I'll explain that term in a moment. It was such an illiquid market that it went down 17 days straight, and I lost $375,000. I couldn't get out of the market. There was no liquidity. That's how much it cost me to learn what I just told you. I couldn't get out. It was just lock limit, lock limit. Lock limit means that, first of all, I need to define limit. The market can only move so many points in a day, and the exchange says it can't move any more than that, and we'll just close off trading. So if a market moves up limit and there's no orders it's rallying and nobody is selling it, it's locked limit. It just sits there. And there's nothing you can do. You can't get out. It's locked, and you cannot get out of your position. Now, if you're long, that's great. You love it because you're making money. It should go higher the next day. If you're short, you can't get out of your short position, and you're not loving it at all because you can't get out. Now you're exposed to another lock limit move. Well, the lock limits happen more frequently in the thinly traded markets, in the illiquid markets, than they do in the large gargantuan markets that trade 100,000, 200,000 contracts a day. So I would like to see you people at least initially stay in these very liquid markets, the markets with a lot of volume where you can get in and out, and you don't get bad fills, you don't get slippage when you try to buy at one price, you get close to your price as opposed to a higher price. So stay with the liquid markets, especially as you start. Remember, it cost me $375,000 to learn that lesson because I was trading very illiquid markets. I had traded illiquid markets being long, and they went straight up as well, which was nice. I had some money to pay for the losses. But there's always two sides to that sword. And it's great to be long an illiquid market when it's up limit every single day, but then you got to get out at some point. And that old greater fool theory, once you're long, who are you going to sell your stuff to? There's got to be some turkey out there that's going to take your stuff, right? Who thinks that you're wrong? And if there's nobody in the pit that thinks you're wrong, you can't get out of it. So stay with the liquid markets, and that alone is going to help you a great deal in your trading. I'm going to back away from terms for just a moment because there's an important point I want to make, and I want to make this early on in the video series, and it's this. There are only two ways of making money in the market. Only two ways of making money in the market. This is critical for your understanding of trading commodities. And the two ways are to either have a small number of contracts and get a big move, or have a large number of contracts and a small move. That's how people trade the market. Very seldom does anybody have a large number of contracts and a large move. But especially for people starting, you're going to want to start with one contract and catch a big move in the marketplace. That's how you make money, as opposed to having big contracts and hoping you'll get a big move. You're going to get too much financial and psychological pressure on you. The person who helped me so much, my mentor, is a guy named Bill Meehan, who taught me so much about the market, so I'm just so indebted to in the 60s. And that was one of Bill's adage. He always said, Larry, you make your money in small moves, small positions, big moves. And then when I became efficient in day trading and could make money day trading, I realized what I was doing was just the opposite. I had large positions in short-term moves. And I'm convinced that's how you either have to be, I'm going to be this type of a trader, I'm going to be that type of a trader. And certainly starting, the day trading and short-term trading, you don't want to do that. That's tough business. It's real hard. It's a lot of pressure on you. You can make a lot of money because you do have large positions and you're in and out of the market relatively quick. But it's so much easier as you're starting and learning about this market, small positions and big moves. Make a lot of money doing that. Most people's investment goal is unrealistic when they come into commodities. Unfortunately, the worst thing I ever did was the year that I took $10,000 to $1.1 million in real-time trading. Really did do that, real money, trading day after day. And now, everybody thinks they can do that. I even think maybe I can do it. So that becomes everybody's goal. Turn $10,000 into $1 million. It's an unrealistic goal. Have you ever had an unrealistic goal and you can't get there and then you feel very frustrated? It'd be much better to say my goal is to take my $10,000 to $20,000. Gee, that's doubling your money. That's better than the funds do. What's wrong with that? Everybody has this grandiose goal of owning the world in 6 months after they get my video course. It can happen. Some people have done that. I have students that have made well over $500,000, $1 million and more. I've got one that's made $6, $7 million now. So it can happen, but these guys did not do it overnight. It took them some time. And they also didn't use just Larry Williams. They thought themselves, too. and they're intelligent people, and they spent a lot of time working on these markets. But they did not have an unrealistic goal of making a killing overnight. That's too much pressure on you. You don't need that kind of pressure on yourself. You want to master your trade here and then go out and see how you can do with it. That's why I suggest you paper trade first. You don't have to open up a brokerage account. You don't have to have any money. And you're not going to lose anything other than some time, and that's your learning experience. I'll tell you, the people that have the most problem trading commodities tend to be doctors and lawyers. Why? Because they went to all that school. I mean, they know they're smart. And they know if they're that smart to become a doctor or a lawyer, they know that this commodity stuff has got to be real easy. So they get into our business of commodities, and they come in with all that enthusiasm, all that motivation, knowing that they know the answer to everything else in the world, and they think they know commodities. And the logic of commodities is altogether upside down. What looks bullish in commodities is actually bearish usually, and they are so convinced of their rightness that it's really difficult for them to realize you have to relearn the whole logic of the world is not the logic of the markets, which is why most people lose trading the markets. They bring into the markets the same logic that they've been using every single day in their life, and it does not work in the marketplace. Because the public, the masses, can't be right. Think about that for a moment. If the masses were right, if we were all right trading commodities, what would happen to the world? Nobody would work. We'd all trade, right? We'd all be pork belly traders. Now that would be a very uninteresting life. So just the way it works out, we can't all be right in the marketplace, and the stumbling block that I see is this logic is just totally reversed. What looks like it should work in the marketplace using normal everyday logic isn't going to work. You have to reverse your understanding. Medicine and law is a very logical profession, A, B, C, subparagraph E, and you can't bring that logic into the marketplace. And especially if you have a real strong positive attitude. Guy I got to know a while ago, Tony Robbins, does a lot of motivational classes. And Tony said, boy, you're going to love my class, Larry. I'm going to give you so much motivation. You're going to feel so positive about what you're doing. I said, Tony, that's my problem. And I'm too positive about what I'm doing. I got to be careful when I trade commodities. You know, this is playing with fire. I can't rush in there with all this great, hey, super enthusiasm. That's the last thing you want to do. I mean, you need a little bit of that, but boy, you don't need too much of that, because then you'll fools rush in. And you do need to have a little wisdom so you don't rush in too much of this stuff. Well, so that's how you're going to make money, either small positions and large moves, or short-term traders, large positions and small short-term moves. That's how you make your money those two ways. And I'm going to show you how you can tell when those large moves begin. That's where you're going to get to out of this series of tapes. And then later on, if you short-term traders, we can show you how to do short-term trading as well. But it's better, I think, to start trying to figure out the long-term moves, because it's a lot easier to do. You don't have as much data. You don't have as many problems dealing with that. We have another term we need to work with, and that's open interest. And we're going to use this a lot to help us tell what the market's going to do. Oops. Open interest. And to make it simple, let's just call open interest a reflection of volume. Open interest shows activity. We're just going to call this activity for now. It's a little complicated for beginners to understand. You can ask your broker about it if you want to. You can read some books about it. We're just going to call this activity. And later on, I'm going to show you how you can use open interest to tell when the activity is telling us to be a buyer or a seller. Open interest is important. I don't use volume very much. I use these figures a lot, the open, high, low, close, and I use open interest. Those are the primary sets of data that I get every single day from the marketplace that I use. There's some other terms that we need to work with. Let me show you what those are. We also have some terms called the market. People say that the market gapped, and let me explain that to you. This is the high. Yesterday was, say, 65. The low was 53, and it closed at 61. The next day, the market opens up here for some reason. There was a tremendous amount of bullishness, and the market opened at, say, 67. So while it closed last night at 61 cents, because this news came out, there was a gap in the market. So we'll call this a gap. If you hear people refer to a gap, you'll know what it is. It's the price difference between the close and the next day's opening. this case would obviously be an up gap. If it opened down here, it would be a down gap. I found these gaps are tremendously important. They're very valuable trading information we can glean from these gaps. I use gaps a lot, as you'll see in some of my patterns. Some of the strongest work that I use involves gaps. So when I talk about gaps, you'll know I'm talking about the change from last night's close to this morning's opening, whether that's a higher opening or whether that's a lower opening. Interestingly enough, most people, if they call up, say, their stockbroker, they'll say, how's my stock? And the stockbroker may say, well, your stock closed today at 60 cents, and yesterday it was at 59 cents, or $59. It was up $1 for the day. Up $1. That's the way the public looks at the market. I don't look at the market that way. I look at where the market opened that day. Let's say the market opened at 63 and came down here to 60 and closed at 60. While it was up for the day, it was way off of the opening. The professionals in the market, and I'll show you how we're going to measure that later on, the professionals look at the opening versus the close as opposed to the close versus the close. The public is looking here. You, great unwashed masses out there, have only seen this relationship, close-to-close relationship. And I'm going to show you that this is the important relationship, the opening to the close, where the market opened and how it finished, because every day is a battleground in this business. The market opens and then the battle goes on. Somebody tries to move the market higher, somebody tries to move the market lower. How's the battle won? Is it won by those pushing above the opening or those pulling down below the opening? That's the battle that's important, especially for short-term trading. Tremendously important. It's one of the most profitable things I've ever done trading, using that opening price. So we're going to work on the opening price, and that's why it's important you understand that there's gaps, and we're going to look more at the relationship of the opening to the close than the close to the close. The professional viewpoint is opening to the close. Today's opening to today's close. The public viewpoint is what's the net change from today to yesterday. They're not even aware of an opening price. Most of you watching this videotape at home for the first time probably say, gee, I didn't even know that there was another set of data, an opening price. You maybe only knew there was close to close. Maybe of you knew there was a high and a low for the day. But it's the opening that's so important that we'll get into if we're entering the market, timing our entry trades, and also for showing when a market's under accumulation distribution. There's a question here, please.
Larry, is there some special term for that relationship of opening to close on a given day?
No. There should be. We should have a name for that, but nobody's come up with it. I guess would call it GORP or something, the gap from the opening and the range or something, but no, there really isn't. It would be nice to have a term, but it is an important consideration to look at in the marketplace. And thanks for the question. Again, if you people have questions, feel free to ask them. And you people at home, if you have questions, I'll tell you a little bit about how you can ask questions to me as well. I will do that in the start of the second tape. Okay, I think that may be all of the data that we're going to be looking at least initially. There are different ways you can give an order to your broker, and I'll tell you what those ways are. We have terminology we use when we call a broker up. We'll say buying on a stop. I told you what that is earlier. If the current price is here and we want to buy up here, in other words, we want to see the market prove itself by rallying up there, we'll call that buying on a stop. If we think the market might drift down a little bit and then go up, and we want to be a buyer down here, we'd say, and let's say we're going to give a specific price, 60 cents. Here, we want it to come down to 57 cents. We'll say buy at 57 cents limit, or you could also say or better. That tells the broker your order is below the market, that it must come down to that price and you'll be filled there. Whereas buying on a stop says it must move up to that price and you'll be filled there. The only other order you need to consider is if you want to buy it right now, you'd tell the broker you're going to buy it at market. If you hear yourself using this order a lot, at market, buy it at the market, you're probably doing the wrong thing. This is a very nervous order. This is the order you're just telling your broker to get you out, or get you in so quickly you haven't even thought about it. You just get. A broker told me the other day, somebody called him up, And he said, get me out. And the guy said, well, what contract? What are we trading here? Oh, but you know what I'm trading. The broker said, I don't know what you're trading. You got 4 or 5 positions. Well, that one. He said, which one? He said, the bond market. He said, okay. He said, how many are we selling? What? All of them. So you need to know, if you're doing at the market, you're probably way too emotional. And you've got to control your emotions. I almost always buy on a stop. I want the market to prove itself. I'm a chicken. I want somebody else's money to move it from here to here to prove this market is really going. Because if I'm having the market come down here, then it's coming down, isn't it? What is. What is it coming down? And I'm trying to catch something that's falling. In my experience, I'm not strong enough to catch these markets that are falling. Most of the time, they keep falling. So I buy it at 57 cents, and the next thing I know is down here at about 50 cents. And then pretty soon it's down here at 40 cents. I don't know what to do. Here, at least I know it's come up here, and I've got some base down here where I can place my stop and say if it falls down, I'm going to get out of this trade. But to just buy weakness can be really dangerous. If there's a rule I could give you, especially starting out, don't buy weakness, buy strength. Let the market prove itself to you with somebody else's money that your idea the market might rally is correct. Somebody else already rallied it for you. And you don't have to put up that money. Yeah, you're not going to make that money in there as well, but you've got some evidence, some hard, fast evidence from the universe of trading commodities that this market is now moving up. Whereas if you want to buy it and the market moves down and you're buying weakness, there's no evidence at all that the market might move up. In fact, the evidence is the market's moving down, and you want it to go higher. I don't want to disappoint you people, but the market doesn't care too much what you think is going to happen. I can see some of you have encountered that experience already, right? Yeah. So this way we can at least say, well, the market's telling us that this should be going higher, and now I can take. So I'm usually buying on a stop. I'll tell my broker, buy on a stop, whatever that value is, and I'll show you how we get those values. And then he knows or she knows it means the price must go there. If I now have a profit in the market, let's say the market's done something like this, and I bought here on a stop at, say, 60 cents. And this market's moving along, and for whatever reason, I've got a target up here to get out at 70 cents. I can tell the broker, exit or sell at 70 cents or better. Now, I can just give that order to the broker, and I can also say GTC. It does not stand for gentlemen at all. It stands for good till canceled. Good till canceled. Now, that order will stay there until I tell them I don't want to use the order any longer. So the day that I actually make the trade, I can say buy here, exit at 70 cents or better, GTC, and if I want to risk on the trade, whatever this value is, say this value is 55 cents, I could also put a sell at 55 cents, also GTC, and my trade's done. Now, only one of two things can happen. Well, actually a third thing. The market's either going to go to 70 cents, or it's going to go to 55 cents, or I'm going to die and the broker's going to close out the trade. Those are the only three things that can happen. It's either going to go up to there, or it's going to go down to there. So I now have established all of the parameters of the trade. I have my target, I have my stop, and now the dice are rolled, and you got to see how they're going to turn up. So the GTC is an important order that you can put in there, and you can go about being whatever you want to do the rest of your regular business life. You can go back to practicing law or whatever your profession is. The trade's over with. Now the broker is assigned with the responsibility of monitoring those prices for you and getting you out when those prices go to those price levels. So you're through with the trade. And that's why I like to trade as opposed to being in the minutia. I've done so much of the minutia trading with quote screens and charts and all that stuff around me. It fits my lifestyle to trade like this. Buy it, place your target, place your stop, walk away from it. Trade's done. Then you can get back to something that you'd rather be doing, or at least something with a lot less pressure in it. And most brokerage firms have nice little brochures that explain all these terms. If the terms aren't totally clear to you or you have some questions about them, don't ask me, please. Ask your broker. They've got some great little brochures that the exchanges print up. They'll send them to you. They're free. They explain all the terms, and there's some more terms. The ones I'm teaching you today are the basic terms. But the books are there, and you can get them from the brokers. And if you're unclear about the mechanics, don't bother me with that. Bother me with questions about the market. That's not a bother, because I enjoy answering those questions. But answering questions about the mechanics of the market, that is a bother for me. Ask your brokers those questions. Let me tell you about who the players are in the marketplace. This is who's in the pool swimming here. We have people known as technicians. We have people known as fundamentalists. You'll hear another term, which is speculators. And then you'll have commercials. You'll have floor traders. And you may also hear on floor and off floor. I'll briefly define these. Technicians are people that keep charts, or computers anymore. Technicians use charts and computers because they're looking at primarily just price structure alone, thinking that we can divine the future of the pork belly market. If we sit here and study this chart long enough, we can say, oh, this is going to happen because some relationships in the price. That's what a technician does. A fundamentalist doesn't look much at the price, but a fundamentalist friend over here is going to look at how many hogs are in existence right now, what's the birth rate of the hogs, is bacon a popular thing to eat right now, or is it not popular? Is there a disease in the crops? What's the price of corn? Looking at the fundamental price supply-demand relationships. Speculators is just kind of what the word stands. That's people who are just stepping in the marketplace and trying to be buyers and sellers. Commercials. This